Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you 7702 Retirement Plan Explained for Dummies. So I want to make sure that I'm talking very slow regarding the 7702 Retirement Plan. If you ever grazed the surface on that or ever, was told by an advisor or some sort of insurance salesman about a 7702 retirement plan. So I'll go into kind of the pros and cons of those specific plans. Essentially, the idea behind a 7702 retirement plan is it's a type of cash value life insurance plan where you could leverage cash value to then receive tax-free income at a later date and time. Now, that's the basic aspect of it, but understand that it's a lot more complicated than that. 7702 is the sort of a provision in the IRC, the Internal Revenue Code, that allows life insurance to, or the cash value of life insurance, to grow tax-free, to get disperse tax-free, meaning pull out tax-free income, and then also leave a tax-free death benefit to your loved ones in the process, because once again it is a life insurance policy. So what happens is with a typical life insurance policy, you have somebody that would place premium dollars into a plan. So kind of think of this egg shape like a life insurance policy, or a permanent life insurance policy at that. So typically what happens is you have to have a death benefit that's associated with that life insurance policy to deem it a life insurance plan. So if this death benefit is high, well, then you have this portion over here that's known as cost of insurance and all those miscellaneous charges, and then a secondary portion which kind of acts like a savings account, which is known as cash value. So if you're going and let's say you're placing in $100 per month into a type of life insurance plan, and you have a death benefit that's $500,000, well, then you're going to have more expenses with a higher death benefit plan than something that's only $100,000. So if we use another egg-shaped type example, maybe this egg shape that's showing a majority of it being the cost of insurance for a $500,000 plan, we're using that same example, maybe now you have maybe only half of it for a $100,000 plan, and then half of it is going towards that cash value. So what's happening is the cash value is increasing every time that you're already sufficing what those charges are, what the cost of insurance are, what those miscellaneous expenses are, all those different things that's typically tied to whatever that death benefit is. Because the way that the insurance company is looking at it is they're saying, okay, we want to make sure that our net amount at risk is as low as possible. Anytime that our net amount at risk is high, well, then we're going to transfer that risk in the form of charges to the insured, to the person that owns this policy. So if you're going, and already one of the first tricks is to make sure that you're reducing that death benefit down to a bare bones minimum. Now, they have certain provisions in there, which are known as like modified endowment contracts. You might have heard the term MEC before, which states that you cannot have the death benefit too low. You have to make sure that if you're placing specific dollars into this account, that it has to pass certain guideline tests to say, as long as there's X amount of cash value, there has to be something known as a cash value corridor that correlates cash value to death benefit. So that death benefit always has to be higher than what the cash value is to make sure that it's not forcing your policy into a MEC, which a MEC just means that it would be deemed a qualified retirement account. So in order to make sure that you're staying with all the reasons on why you want to set up a 7702 retirement plan in the first place is because you want to make sure that you're receiving, that you're growing this money as much as possible in a tax-free manner. So you're honing in on taxes, making sure that all the monies that you're placing aside, it's maximized, it's growing into an account that's growing tax-free. You could pull this money out tax-free, and then because it's still life insurance, whenever you pass away, regardless of if that's in 2 months or if that's in 30 years, there's going to be a tax-free death benefit that would go to your loved ones. The second aspect is also inflation. If we understand that inflation is increasing between 3 and 4% per year, and we have volatility in the market, well, we want to have something that will constantly credit in addition to what this cash value savings account is compounding to. So each year, if we use the same $100 example, and maybe in the first example, you had about $90 was going to the cost of insurance and only $10 was going to the cash value. And then example number 2, maybe now you have $20 that's going to the cost of insurance and $80 that's going into the cash value. Well, your cash value bucket is going to be gaining by the extra $80 per month. And then on top of it, this cash value could be tied to different sorts of interest credits. The way that that works is you could have these plans set up in a whole life insurance policy. You could have it set up in a universal life. A whole life means like a fixed that gets paid out in the form of a dividend. Universal life is a form of indexing strategies. Will gain when the market goes up, tied to whatever indexing strategies you choose based upon that company, and will gain 0% whenever the market goes down. You have variable universal life, which is tied to mutual funds, or you have universal life, which is tied to interest rates, which are obviously interest rates are very, very low right now. So this is typically my go-to. What I recommend is the IUL plan because I believe it gives you the best flexibility, the best power for growth, and also allows you to utilize that death benefit and manipulate the death benefit to your advantage the most proper way. So as I clear up the screen, we'll go to the bullet point number 2. What are the problems with these types of plans? And the problems are that a lot of times you have insurance agents that don't understand how you can utilize these plans the best way possible. And what they do is they shove too many charges into these types of plans. So when you have too many charges, you have less money that's going into the cash value and allowing that cash value to become accentuated, or they might be placing you in with a specific carrier that just does not have a good plan. You know, one of my go-to plans that I constantly talk about is an IUL plan. Now, you have hundreds of different IUL plans available per state. Out of the IUL plans that I recommend, I only recommend about 3, maybe 3 to 5. And then there's one company in particular that really allows us to reduce that net amount at risk to the lowest amount possible so that we're maximizing out that cash value as much as possible so that if somebody wants to retire in their 50s, in their 60s, in their 70s, they could pull out everything properly. So what you want to do is understand what the costs are associated with these types of plans, and then how to also maximize your crediting strategy. Because if we're utilizing that same egg-shaped type example, if we could set something up where we understand that your death benefit, we could make this, if your sole goal is to make sure that you're maximizing out and you're utilizing this for retirement, you're not so concerned with death benefit protection, well then we could make sure that we're reducing this down to its bare bone minimums. And we're also utilizing certain features with specific carriers that allow us to reduce this net amount of risk as well. One carrier in particular, they have something known as an IPA agreement, which states that this death benefit, rather than get paid out to a lump sum to your beneficiaries, you could actually annuitize out this death benefit to make sure that that net amount of risk is going to be much further reduced, and therefore resulting in, for each dollar that you're placing in there in premium, maybe you might have cost of insurance and miscellaneous charges of this much, and you have maximized cash value of this much. Also, with the cash value, if we understand that we're reducing the cost as bare bones as possible, well then how exactly can we maximize out that interest credit as well? So you have certain accounts that might cap you at about 12% in a given year with the IUL plan. You have other accounts that might cap you at about 17% in a given year on that specific IUL plan. So you want to make sure that all of these different components are set up properly for your exact specifications, for your exact age, for your exact goal. If you're in your 30s and you want to retire at age 55, well then there's going to be a specific carrier and a specific type of manipulation that you could set up with these 7702 plans that fit like a perfect puzzle piece for your exact situation. And that's one of the things that we try to help you guys out with. Time and time again, we see people fall victim to traditional retirement accounts, such as contributing to their 401k when the 401k is not giving a match, such as contributing to some sort of qualified account which they're going to drill you with taxes later on, or you're paying enormous amount of mutual fund related fees, you're susceptible to downward market losses. So those are the problems that happen with traditional retirement accounts. One of the things that we try to do is after we explain the process to you, when we ask you a whole slew of questions, we'll actually send you a 7702 retirement plan report that does the comparison amongst qualified accounts such as 401ks, 403bs, IRA accounts. You have non-qualified accounts such as mutual fund accounts. You have Roth IRA accounts, which typically you might have heard another term for this would be like a rich man's Roth. If you make too much money, you phase out. It's something known as phasing out of a Roth IRA, meaning if you go above a certain limitation with income, or you have aspirations to make certain amounts of income, you could go and place dollars into a Roth IRA account, which will provide you tax-free income later on. But if you make too much money, you can't contribute into a Roth IRA anymore. So that's why a lot of people try to try to utilize a 7702 plan to make sure that they could shove many dollars into these types of programs so that they could receive tax-free growth, tax-free income, and a tax-free death benefit all at the same time. So even though that sounds fantastic, many times individuals, I'd say 9 out of 10 times, they set up a 7702 plan the wrong way. What we try to do is we specialize on these plans. We have access to all the top carriers. We make sure that we're doing our due diligence to match it up like a perfect puzzle piece for your exact situation. At any point in time, if you found value in this video and you want to get a free report on the 7702 retirement plan that's specific to your needs and see a comparison report, give us a call. It's 1-800-566-1002. We offer 24/7 customer service. You can give us a call mornings, nights, weekends, holidays, whatever the case may be. We implemented this 24/7 customer service a couple of years ago to make sure that we could handle national volume. So in your particular area, there's going to be a different plan than somebody that could be 5 states away from you. So we want to make sure that that we're doing our due diligence, that we're educating you properly. Education is the key to a 7702 retirement plan, and that's what we're trying to get across at all angles. We're A+ rated on the Better Business Bureau. We've never had any bad reviews or any complaints. We've always had very good reviews, and at any point in time you could look us up. You could subscribe to our YouTube channel. That's what I recommend, is to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. I hope you guys learned some things. Feel free to give us a call, and I look forward to speaking with you either personally or having you deal with one of my specialists. Take care.